Welcome to the lecture series on time value of money, concepts and calculations. The topic of the today's lecture is valuation of shares. There are many types of shares, out of which preferred shares, ordinary shares, etc. Now, let us see what is a preferred share. A preferred stock is a class of ownership in a corporation that has a higher claim on its asset and earnings than common stock or common shares. Preferred shares generally have a dividend that must be paid out before dividends to common shareholders, and the shares usually do not carry voting rights. And for ordinary shares are the most common type of shares traded on the equity market. Ordinary shares give you full voting rights at annual general meeting. Dividends, should the company pay this, and a share of the residual economic value should the company unwind after bondholders and preference shareholders are paid. They also allow you to benefit from capital growth should the company do well. Valuation of preferred shares. Preference shares like debentures are usually subject to fixed rate of return or dividend. In case of no stated maturity, their valuation is similar to perpetual bonds. The present value of the shares PVs is equal to summation T is equal to 1 to infinite dP divided by 1 plus I to the power T, or is equal to dP by I, where dP is equal to per share dividend expected at the end of a year, which is fixed, and I is equal to discounted rate annually. The value of the redeemable preferential share is given below. Present value of the share PBS is equal to summation T equal to 1 to n dP divided by 1 plus I to the power T plus MB divided by 1 plus I to the power n, where dP is equal to per share dividend expected at the end of a year, this is fixed value, I equal to discounted rate annual, MV is equal to maturity value, that is par value or face value, and PBFA is equal to present value interest factor for annuity, which is equal to in brackets 1 plus I to the power n minus 1 whole divided by I into 1 plus I to the power n. This is the present value of a annuity, and n is the maturity period in years, and PBIF is the present value interest factor and is equal to 1 by in brackets 1 plus I to the power n. Computation of value of shares with respect to following dividend valuation or dividend discount models. The first model we will consider is zero growth model. The second model we will consider is constant growth model or Gordon model, and third is the variable growth model. Now, to start with the zero growth model. In this approach to dividend valuation assumes a constant non-growing dividend stream with zero growth in the amount of dividend. Thus, the value of the share is the present value of a perpetuity of dividends discounted at discount rate I. So, the present value of the shares is PB is equal to in summation T equal to 1 to infinite D divided by 1 plus I to the power T, and which is equal to D by I, where D is equal to constant dividend per share and I is equal to discount rate or required return of investor. Let us take an example. Example 1. Messrs SJ International's per share dividend remains constant indefinitely at rupees 8. Assuming required rate of return, that is discount rate of 20%, compute the value of the share of Mr. SJ International. The solution is PV is equal to D by I is equal to rupees 8 divided by 0.2, which is the value of I, because I is 20%. So, rupees 8 divided by 0.2 comes out to be rupees 40. The Gordon growth model. The Gordon growth model is used to determine the intrinsic value of a stock based on a future series of dividends that grow at a constant rate. Given a dividend per share that is payable in 1 year and the assumption that the dividend grows at a constant rate in perpetuity, the model solves for the present value of the infinite series of future dividends. Derivation of the model. The model uses the fact that the current value of the dividend payment can be expressed at D0 in brackets 1 plus g to the power t at discrete time t is D0 1 plus g to the power t divided by 1 plus I to the power t. Now, when I divide the dividend with 1 plus I to the power t, basically I am converting it to its present value. And so, the current value of the future dividend payments, which is the current price of PVs, is the sum of the infinite series. So, what I am doing, that PV is equal to summation t is equal to 1 to infinite D0 1 plus z to the power t divided by 1 plus I to the power t. So, the present values of all the dividends are summed to find out the value, present value. This summation can be written as PVs D0 into R dash in brackets 1 plus R dash square plus R dash cube and so on so forth, where R dash is equal to 1 plus G divided by 1 plus I. Clearly, the series in parenthesis is the geometric series with common ratio R dash. So, its sum to 1 by 1 minus R dash if R dash is less than 1. Thus, PVs is equal to D0 R dash divided by 1 minus R dash. Substituting the value of R dash and solving gives PVS is equal to D0 1 plus G in brackets divided by I minus G equal to D1 divided by I minus G. The stable model is value of the stock D1 divided by 1 I minus G, where D1 is the next year's expected annual dividend per share, I is equal to the investor's discount rate, G the expected dividend growth rate. Note that this is assumed to be constant. Now, let us take an example. Exercise 2. Messrs SJ Internationals has paid following dividends per share per year and assuming a 20% required return, that is discount rate, and rupees 5.85 per share dividend in year 7, compute the value of this share. Now, it has given that for year 1 the dividend per year share is 3.3, for the second year the dividend per year share is 3.63, for third year this is 3.99, for the fourth year this is 3.39, the fifth year this is 4.83 and sixth year this is 5.32. Now, PV is equal to D0 1 plus G in brackets 1 minus G is equal to D1 1 minus G. D1 is equal to D0 1 plus G and D6 is equal to D0 1 plus G to the power 6, or D1 by D6 is equal to 1 divided by 1 plus G to the power 5, or G is equal to D6 divided by D1 to the power 1 by 5 minus 1. So, D6 is 5.32, this 5.32 and D1 is 3.3 and 1 by 5 is 0.2 and then minus 1 comes out to be 0.1, or G is equal to 10%, and that is why PVS is equal to 5.85, because D1 value is 5.85 divided by 0.2 minus 0.1 is equal to rupees 58.5 per share. This 5.85 has been brought from here in the 7th year. Okay. Exercise 3. Consider a share with an expected dividend per share next period of rupees 3.25. A cost of equity is 20% and an expected growth rate is 8% forever. Find the value of the stock or share. Value of the share is equal to 3.25 divided by, in the brackets, 0.2, which is 20% here, and minus 0.08, this is growth rate is 8%. So, divided by 100 is 0.08 and 20% divided by 100 is 0.2. So, 0.2 minus 0.08 is equal to rupees 27.08 per share. Now, let us see what are the limitations of the Gordon growth model. The main limitation of the Gordon growth model lies in its assumption of a constant growth in dividends per share. It is very rare for companies to show constant growth in their dividends due to business cycles and unexpected financial difficulties or successes. Therefore, the model is limited to firms showing stable growth rates. The second issue has to do with the relationship between the discount factor and the growth rate used in the model. If the required rate of return I is less than the growth rate G of dividends per share, the result is a negative value, rendering the model worthless. Also, if the required rate of return is the same as the growth rate, the value per share approaches infinite. Now, let us take a third model, which is called variable growth model. The variable growth model is a dividend valuation approach that allows for a change in the dividend growth rate. As a dividend valuation approach, this model incorporates a change in the dividend growth rate, assuming G1 is equal to initial growth rate and G2 equal to subsequent growth rate occurs at the end of the year n. The value of the share can be determined as follows. Step 1. Compute the value of the cash dividends at the end of each year, that is dt. Cash dividend at the end of each year is dt, t is time, during the initial growth period, and initial growth period is year 1 to n. So, dt is equal to d0 1 plus g1 to the power t, and this is for initial growth period year 1 to n. Step 2. compute the present value of the dividends during the initial growth period as summation 1 to n d 0 1 plus g 1 to the power t divided by 1 plus I to the power t. When we are dividing it by 1 plus I to the power t, we are basically converting into the present value. So, this is equal to n summation t is equal to n dt divided by 1 plus I to the power t. Now, step 3, find the value of the share at the end of the initial growth year. P n is equal to d n plus 1, this is d n plus 1, that means d at nth n plus 1th period divided by I minus g 2. This is the present value of all dividends expected from year n plus 1 onwards, assuming a constant dividend growth rate g 2. Because in the second part, which is n plus 1 onwards, the growth rate is g 2. The present value P n would represent the value today of all dividends expected to be received from year n plus 1 to infinite, and this is equal to d n plus 1 divided by I minus g 2 into 1 by 1 plus I to the power n. So, this converts all dividends, the summation of the dividends to its present value, because I am multiplying with 1 divided by 1 plus I to the power n. Step 4, add the present value components found in step 2 and step 3 to find the value of the shares. So, share value is equal to, this is what I have got in step 2. So, this is here, and what I got in step 3, this is here. Now, let us take an example. This is example 4. In the most recent years, the annual, that is in 2012, dividend paid by Messrs SJ International is rupees 4 per share. An annual increase of 12%, that is G 1, is expected over the next 3 years. At the end of the 3 years, that is end of 2015, the dividend growth rate will slow down to 6%, that is G 2. Assuming 14% is the rate of return, 1, compute the current value at the end of 2015 of the share of Messrs SJ International. Now, let us see the solution. We will solve this problem stepwise. Step 1, determination of present value of cash dividends received in first 3 years. Now, if you see this figure, at the end of the first year, the d 0 value is 4, this is 1 plus g 1 to the power t, that is 1 plus g 1 to the power 1 is 1.12, and hence when we multiply these two, this comes out to be 4.48, and this is the value of dt is equal to d 0 1 plus g 1 to the power t, here to the power t. Now, if you find out the present worth factor, this is 1 divided by 1 plus I to the power t, and the present worth factor is 0.877193, and hence present value of this dividend is equal to this dividend into this present worth factor gives you 3.929825. Now, here pictorially this is shown. At the end of first year, this is 4.48 rupees, and when this will be brought to the present value as t equal to 0, this becomes 3.9298. Similarly, in the year ending 2, D 0 value is 4, 1 plus G 1 to the power t, here t becomes 2, becomes 1.2544. When these two are multiplied, this becomes 5.0176. So, D 2 is equal to D 0 1 plus G 1 to the power t, and here the value of t will be 2. So, this is the value. Now, the present worth factor for this, that is 1 by 1 plus I to the power 2 whole to the power 2 is 0.769468. When I multiply this with this, it becomes 3.86088. Now, if I see this pictorially, at the end of the second year, this value is 5.017, this is the same value, and when this will, the present worth will be calculated, it will be brought to this 0 line. When we brought it to the 0 line, this becomes 3.8609, which is the present worth of this value. Now, if we see the year ending 3, this is the D 0 is 4 and the growth factor, that is 1 plus G 1 to the power 3 is 1.728. Then this D t is equal to D 0 1 plus G 1 to the power t is the multiplication of this and this, comes out to be 6.912. Now, if you see the present worth factor, this is 1 divided by 1 plus I to the power 3 comes out to be 0.674972, and we multiply this with this, the present value of this becomes 4.665403, and we add these three present values, it is 12.456108. So, the sum of the present value of the dividend for last 3 years, this is 3 years, is equal to this. This is given by the formula, this I t equal to 1 to n d 0, this is n is 3 here, 1 plus g 1 to the power t divided by 1 plus I to the power t, it is t equal to 1 to n dt 1 plus I to the power t here, comes out to be 12.456108. Now, step 3, the value of share at the end of the initial growth period, that is end of 15, is D 3 is equal to 6.921, this we have taken from the step 1, and D n plus 1, that is 4th year, end of 4th year, is equal to D 2016 is equal to D 3 into the growth rate. This is G 2, 1 plus 0.06, because after the 3rd year the growth rate changes to G 2. So, we have taken the new growth rate 0.06, it is 6%, comes out to be 7.336. So, by using D 2016 is equal to 7.336 and 14% required return and a 6% dividend growth rate, we can calculate the value of the stock at the end of 2015 as follows: D n plus 1 divided by I minus G 2 is equal to 7.336 divided by in bracket 0.14 minus 0.06 is equal to 91.7, and this is P 2015. Finally, the share value of 91.7 at the end of 2015 must be converted into the present value, that is end of the 2012. So, we have to divide it by 1 plus I to the power 3, it converts into this 91.7 converts into rupees 61.895. Now, step 4, value of the shares end of initial growth period, that is the end of 12, is the earlier the present value of the 3 we have already calculated, it is 12.456 and this one is 61.895. So, we add them up to rupees 74,351 per share. At last, we add the PB of the initial dividend streams found in step 2 to the PB of the stock at the end of the initial growth period found in step 3, we get this. Now, other approaches to valuation of shares. In addition to the dividend valuation approach discussed above, there are other approaches for valuation of shares, and these are: one, book value, second, liquidation value, and third, price earning multiples. Now, book value. The approach uses the book value per share BBPS as the basis for valuation of shares. The BBPS is the net worth, that is equity capital plus reserved and surplus, divided by the number of outstanding equity shares. Alternatively, BBPS is the amount per share on the sale of the asset of the company at their exact book value minus all liabilities including preference shares. Now, let us take an example to demonstrate this. Example 5. Messrs. SJ International has total asset of rupees 70 crores, total liabilities including preference share is rupees 50 crores and 10 lakh shares. Calculate the book value per share. So, this is equal to, this is asset 70 crores minus 50 crores is liabilities divided by 10 lakhs is equal to rupees 200. However, the BBPS is not a good proxy for true investment value. For one thing, this approach relies on historic balance sheet data. Moreover, it ignores the expected earning potential. Similarly, the BBPS has no true relationship to the market value of the firm. Now, the second one is liquidation value. This approach to valuation of share is based on the liquidation value per share, which is equal to LBPS is equal to value realized from liquidating all assets minus amount to be paid to all creditors and preference shareholders divided by number of the outstanding shares. Let us take an example to demonstrate this. Example number 6. The total asset of Mr. SJ International be liquidated for rupees 70 crores. Its total liabilities including preference share is 50 crores and 10 lakh shares. Find the liquidation value per share. It is 70,000 minus 50 divided by 10 lakhs is equal to 200. The LVPS is a more realistic measure than book value, but it ignores the earning power of the asset of the firm. Moreover, it is difficult to estimate the liquidation value of a going concern. For above reasons, the LVPS is also not a true proxy of the true investment values. Now, price oblique earning, that is PE ratio. The price earning PE ratio reflects the amount investors are willing to pay for each rupee of earning. The price earning multiple approach is a popular technique used to estimate the firm's share value, calculated by multiplying the firm's expected earning per share by the average price oblique earning PE ratio of the industry. Now, let us take an example. Example 7. Messrs. SJ International is expected to earn rupees 12 per share next year, that is 2017, assuming the industry average PE ratio to be 10, what will be the firm's share value? Solution: the firm's share value is equal to expected earning into average PE ratio. So, is equal to rupees 12 into 10, which comes out to be rupees 120 per share. The PE multiple approach is a fast and easy way to estimate a stock's value. However, PE ratio vary widely over time. Third, when using this approach to estimate stock values, the estimate will depend more on whether stock market valuations generally are high or low rather than on whether the particular company is doing well or not. Relationship among decisions, returns, risk and share values. Any action of the financial manager that increases the level of expected return, that is D1, G, without changing risk I should increase the share value. The second, the action of the financial manager that reduces the level of expected return without changing risk should reduce the share value. Third, likewise, keeping the expected return constant, any action that increases risk required return will reduce share value. Fourth, keeping the expected returns constant and any action that reduces risk, that is required return, will increase share value. Summary, what we have taught in this lecture: ordinary shares and preferential shares discussed, valuation of preferential shares discussed, valuation of ordinary shares based on dividend valuation or dividend discount model, that is 0 growth, constant growth and variable growth models discussed, other approaches for valuation of shares such as book value, liquidation value and price earning multiples discussed, relationship among decision, return, risk and share values discussed. With this lecture I am ending my course. I hope you should have enjoyed my course and best luck for you for the examinations. Thank you.